You learn more, you earn more. It is time for another episode of Ask Pat, where Downing-Frye Realty's Director of Corporate Training helps you become more productive, professional, and profitable in your real estate career. Please welcome Pat Patoki and Cindy Woolley.
Happy New Year, everyone.
Happy New Year.
Happy New Year.
Yeah, so it introduced Cindy and Pat, but we've got some fantastic guests with us today from the team at FDM Mortgage. Brett Carter, Nitesh, I'm gonna just
Donish. It's all right. It's a hard one.
and Jack Stoltman joining us. We were expecting one of your teammates, Javier, but unfortunately he's ill, and we wish him the very best. Hope everyone's staying healthy this new year. And so today, this is the start of our 2022 editions of Ask Pat, right? And it's a great opportunity to ask Pat and talk to some of our preferred partners about what's happening and what's hot in the industry. So it sounded like there's a lot changing and a lot coming up in the mortgage industry, Pat. So we've got a lot to talk about. I'm going to pass the microphone to you.
Great. Thank you, Cindy. And thank you, gentlemen, for joining us. Happy New Year to everyone. As we enter 2022, we have wonderfully productive and positive expectations. And one of the things we really want to focus on is helping Fidelity really establish lending and financing as an option. We are blessed in this area with many cash deals, but even with cash deals, there really are times when it makes a lot of sense to talk about leveraging. So the first question I think to Brett would be just sort of an overview. What do you think 22 is going to be like in terms of financing and rates, sir?
Well, I think a couple things we're going to talk about. So, Pat, from a rate perspective, rates are going to increase, right? We've already seen that. The Fed announced that they are going to start to tighten their monetary policy. We've already seen rates trend higher. And we'll talk a little bit about rates and the impact of them at the end of the discussion, but we do expect interest rates to go up. One of the biggest challenges we're going to have in 2022, unfortunately, and it's the reason Javier hasn't joined us, is COVID-19, right? Mm-hmm. 2 weeks to stop the spread is turned into 2 years, now going into 3 years. And with the Omicron variant coming in, which is much more contagious, people don't get as much sick as much, but it's much more contagious. So that's having an impact on us in the marketplace. So that's going to be a reality for us, whether it's on the lending side or on the real estate side. We are going to be dealing with that well into 2022, unfortunately. And that creates some unique challenges for us, say, as a lender, right? When we have vaccine mandates and companies are forcing people to take vaccines, and then some people will resign. So how stable is somebody's employment? How do we verify that at the end? So unfortunately, because we all have experienced COVID fatigue, right? It's not going away in 22. So we're going to have to deal with that. And that's going to require some talent from your loan officer to help you navigate through those processes.
Great. I would tell you, being old in this market is a little bit of an advantage in this regard. I know we're talking about interest rates that will rise, but anything in the threes, of course, many of you are younger, but anything in the threes, Brett, doesn't that seem like a reasonable price when we lived through 13, 12%?
Well, when I started, interest rates were 20%. And that is not an exaggeration, folks. It was 20%. And I started as a loan officer and people were buying houses. So interest rate really doesn't matter. So even if you get to 4%, the forecast is to get to 4% by the end of 22. It's still really affordable. As Jack's going to share with you, especially if you're entering into the home buying market, it's really all about affordability. A slight change, when you're talking about interest rates as low as they are, a 1% change isn't going to have a major impact on your monthly payment. It's really about what's affordable. Can you buy a house today for equal to or less than you're paying rent? If the answer is yes, you should buy a house. For a second home investment or investment property, then that's really the employment cost of money, right? Can you get an appropriate return, especially on the investment side, which is going to be 20% of the market? Can you get an acceptable return on that? So yes, I do expect interest rates to go up, but you're talking about 4% in 22, maybe 4.5% in 23. That's still going to be very tenable, very affordable.
Great. Let's talk about what type of hot market we envision for 2022. And I don't know which of you wononderful gentlemen.
Going to take that.
Yeah, I could take that one, Pat. Yeah, we did a presentation a couple of weeks ago, and we were talking about how in 2022, investors are expected to take up about 20% of the market share, which is significant. And that's an increase from 2021 of 18%. And what that means is there are a lot of, and Pat, you mentioned that in that area, there are a lot of folks fortunate enough to be able to take advantage of cash opportunities, and investors make up a big portion of that. And we spoke to some agents, we have spoken to some investors about leveraging their cash and not just putting all their money into one property and dividing that up. And if they're looking at a $400,000 property, purchasing all cash, they could actually split up that money and buy 3 or 4 properties and spend the same amount. And if you're looking to have an advantage in the market, then instead of maybe getting financing up front, you can purchase cash and still stay competitive, and then turn around and do delayed financing where they actually end up taking the money out and then reinvest. So they still end up being able to invest in multiple properties. For the agents, it's beautiful because it's multiple deals for them. So everybody wins. And one of the things we did want to say when we talk about investors with the market there, and a lot of places, investors are buying condos. And something that we did see recently in the news with the condo complex in Miami, with the collapse, it is bringing on a few changes with the way condos are qualified. Fannie and Freddie are both going to be introducing some changes as far as their questionnaires are concerned and what they are looking for as far as condo approvals. So those are some things we do need to keep in mind as we go into the new year. Those changes will be coming in 2022.
So essentially, we train our folks, and of course, the minute we hear multiple deals, sir, we think that's a great idea. But we train our folks to be the source of the source. You are the folks who can help an investor or a purchaser make the best decision and time that decision with the market so that they can get the best out of their funds. And I think that's great. We definitely look forward to that. Did someone want to
comment
add
on that, Pat? Because I think it's really important now, right?
Sure.
You dealt with it because we've been older in this business, right? Inflation is a real issue right now. And because it's not just selling the house and keeping the transaction, we want our clients to make the best moves. And, one of the things you should do in an inflationary market, now we work with thousands of financial advisors. I've done that in my entire career. One of the best defenses strategy is actually, and if you read anything and work with financial advisors, they'll tell you, borrow as much money as you can, right? That's an inflation defense strategy. You borrow at very low cost. At 4%, it's a very low cost, right? Because you're going to pay it off with future dollars. And here's a really good example, how banks make money. If I borrowed at 4%, I can buy a series bond from the U.S. government paying me 7%. So if I borrow at 4% and I invest that cash, right, do the delayed financing, stay competitive, pay cash, use that delayed financing, harvest that cash back out, borrow at 4%, net after taxes is probably 3%, but now I'm earning 7%. I've got a positive cash flow at 4%, and I'm paying my debt back with future dollars. So we might need to rethink our financial structure as we're going forward. I think it's really important. You don't want to lose the deal to a cash buyer. Fine, pay cash. Look at delayed financing, take that money out, make a better financial decision for you and your family, and then pay that money off with future dollars. We're probably going to be facing inflation for the next 2 to 3 years. So the strategy actually is not to use your cash, keep your cash out and borrow as much as you can, paying it off. And we want to help our clients make better decisions, get the house you want, but also make the right financial decisions for your future.
So we, of course, at Downing-Frye, we have the expertise of Fidelity to draw on and help our folks. So we need to get them to you so
Absolutely.
you can give them their options and explain what those options really are. You talked a little bit about inflation. Is there anything else we should know about that and its effect on the market?
Well, I think you're going to see two things, right? Obviously real estate inflation we've had. Real estate inflation probably has occurred a little faster than market in 2021 to 22. The main thing about inflation now is what financial moves do you make to combat with inflation, right? So You just have to be smarter in your process. Stay cash to stay competitive, but actually borrow as much money as you can on inflation, because the way it works, right, is as inflation goes out, the dollars become cheaper. So I'm paying off debt with future cheaper dollars. So if you look at the really, really smart money on Wall Street, they're borrowing the hell out of money right now because it's cheap, and then they can pay it back with future dollars, right? So when you follow what the smart money does, maybe the individual should do the same thing, because that's going to be a better financial decision for them. So you can do both. You can buy in cash so you're competitive, but then restructure your financing outwards with the delayed financing strategy that Natisha brought up.
Good. It's essentially speaking, purchasing with financing and leveraging is something that we need. We could really use your expertise on, and I think many of our customers can and should. We need to get them to you, and we need to work up some kind of materials, sir, that we can get out to them just to show them, because lots of times people don't realize.
They don't, Pat. They actually use the term leverage all the time. Warren Buffett, who's one of the smartest investors in the history of the planet, always talks about leverage. It says makes you look smart, and your wife will love you, right? So leverage works for him, right? It should work for all of us, right? I'm a big fan of modeling. What works for everybody else, let me follow it. So if he likes leverage, then we probably should like leverage, right?
And when Warren Buffett speaks, we all
people listen. Right? Absolutely.
For sure, absolutely. Another question is, and it was referenced a little bit, some of the changes with the collapse of the Miami Tower, which was obviously just so tragic. But deferred maintenance has become a real concern with Fannie and Freddie, I imagine, with that occurrence in Miami. How is that going to affect particularly first-time buyers who might need to tap into FHA financing, for example, or whatever? And, we're all trapped by Fannie and Freddie and influenced anyway.
Yes, we are. Dish?
Yeah, I mean, the approval process, as I was mentioning, Pat, it is going to change. We don't have all the details yet since it's so recent. But from the news we've been seeing, it's mainly going to be differences in the structural cases, in the reserves that the condo association is going to need, because right now there are already conditions, but some of those questions are not being asked in certain types of loan programs. Fannie and Freddie actually allow, up to now, they've been allowing something called limited review. And in the limited review, which is if the buyer is putting a higher down payment, they have great credit scores, they may qualify for a limited review on the condo association. However, that review process does not ask a lot of the questions that became a concern with this issue. So that limited review process may be going away. And it just means that the qualification process, it's going to end up being pretty strict. We will, in the coming weeks, we will definitely be seeing more details come out of that. FHA still has a very strict process. They go through the full questionnaire. They end up approving the entire condo association. FHA also allows single unit approvals, spot approvals, and that is going to ask a lot of the questions that we're seeing right now, where they may change their questionnaire and add more questions onto that approval process, and approving that one single unit. It likely, unfortunately, it's going to end up being a little more stringent than it used to.
Sure. But it's still, and it's really important that all of us as realtors understand that we need to get our folks to use, so all the options can be laid out. And while some of the options might be a little more onerous than others, for example, Collier County recently just made a decision to reformat all of the rules for rentals, seasonal rentals. We have many seasonal rentals. We're in a resort and second home environment. It's still doable. We know how to do it. It's onerous. I can't change that. I've been screamed at but I didn't make that decision. But we know how to navigate those waters. And the first step is to get these folks to see you. Just in terms of a last question, what do you think, which sort of group of buyers do you think is going to be most affected? by the 2022 market and everything else that's going on?
Well, a few things are changing in the 2022 market. Once I'm done with this, I do want Jack to go into a little bit about the interest rate portion of it.
Good.
And what I will say about that is that, rates are going up. The good thing about it is that it is creating an urgency in the market, right? And people who have been standing on the sidelines, first-time home buyers who've been waiting, they are now jumping at the chance of, still trying to get, rates are still historically low. So they're still trying to take advantage of that and get into the market. And, a lot of folks are, worried that rates are going up, but in our industry, we're hearing that 2022 is going to be a record year. As far as purchase money is concerned, purchase money is supposed to be higher in 2022 than 2021. So because of that, we're expecting that first-time home buyers are still going to be a huge portion of the market.
Okay.
And there are a lot of programs that are still available to them, a lot of grant money, a lot of first-time home buyer down payment assistance programs that we offer at Fidelity, and that we partner up with a lot of the states and counties to get first-time home buyers, that benefit. And, Brett says all the time when he got into the industry, I'm not going to guess how long ago that was, but
No, we don't mention years, sir.
We don't want to
we're not allowed
mention years.
to do that.
Tish, thank you very much.
when Brett got into the industry, there were two issues at that time, two major issues. It was credit and assets. In 2022, those are still the two major concerns: credit.
Funny how
and
that
assets.
happens.
Yeah, and it's a part of that is just lack of knowledge, because there are still buyers out there who are reluctant to get into the market, thinking that their credit is not good enough. And credit is never bad, right? There's no bad credit. There's what is it that you like to say, Brett? I'll let you do this since it's your
challenge credit. Nobody has
no bad credit.
it's
It's just challenge credit. Right?
The words become important. And Jack,
Words matter, Pat.
We did. Oh, well, as a former recycled English teacher, you've made my day, sir. That's all I can tell you. But we don't want to leave Jack out. And I know you were going to talk a little bit about interest rates and inflation and that sort of thing.
Yeah, exactly. Well, I just wanted to piggyback off of what Nitesh was saying really quick about, and if you could pull up that graph for me, Cindy, that would be great, about how rates going up will affect buyers' decisions to move forward with finding and buying a house. And on this graph, you can see as rates go up, more people are going to want to buy faster. Mm-hmm. And the amount of people that this is going to dissuade is so small that the market gets better as rates go up this year. Granted, they're finishing at a historically low point still, about probably 4%. Even if it gets up to 4.5%, that's still going to encourage people to buy as these rates go up, because they're going to be afraid that they're going to get higher, that they're going to get into the fives or something. They don't know what's going to happen. And then also you have the fact that, as we mentioned a couple times so far, that this is still going to be, these higher rates are still going to be cheaper than paying rent. And you have maybe the rate goes up from 3 to 4%, and that's a 33% increase in your rate, but it's less than half of that in monthly payment, about like a 12% increase in monthly payment. But in that same time, that rates are going to go up 30%. Rent's probably going up 30% too. I know just in Fort Myers, which is where I live, rent has gone up about 30% in the last year, just like home prices have gone up 30% in the last year. But your interest rates have not gone up 30% in 1 year.
Neither have the salaries oftentimes for folks. So that's a great chart, Jack, and I think it's a great insight. As with everything, knowledge is power, and I think just as many of you have said, people who think they can't get qualified to purchase with or without financing sit home and stew. Our approach really should be that we get them to you, and you determine can they and when and how can we structure that. And we will do, I know realtors will do everything they can to try to get them to you. It is such a complicated market. It's just like going to a doctor. If you have a foot problem, you don't go to an eye doctor. Well, if you have a financing issue, we need you guys to figure that out and help us with that. And we're
Pat, I
very
think
fortunate. Yeah.
I think you said the operative word, right, for anybody. And I think any homeowner needs to understand this. It's not if, it's when, right? I think the issue is, are you willing to work with partners that will help somebody achieve that goal of home ownership, right? I think one of the things that we believe, it's not whether you can or you can't, it's when you can, right? Now, everybody's path to home ownership might be a little bit different, right? That journey may take different paths, right? Sometimes their journey is a 60-day journey. That's great. Somebody that has other challenges, whether it's challenge credit or their assets or their employment, right? That journey might be a year journey or 2-year journey. That doesn't matter, right? Our collective goal should be say, you know what? If somebody wants to become a homeowner, that's what we're supposed to do, right? As lending partners and realtor partners, that's what we're supposed to do, right? And understand that, that's the true key to success, right? There's the immediate transactions for me. But if I want to become a superstar agent, my year transactions or 2-year transactions, those are the prospect funnels that build business for me. So I want to keep them in, keep them engaged, and keep them motivated. And that's one of the things that we do as well. We don't believe that anybody can't buy a home. We believe everybody can. It's just, when is that going to happen for them? And we want to keep them on that path.
Absolutely. And I think, the research for realtors has always indicated that people start looking around 18 months before they actually purchase, even in this type of fast moving market. So what Brett is saying and what everyone has said is really, really important. Make sure that you base your decisions on facts and you have that knowledge, and you'll be ready when. And hopefully we'll find the magic in opening that door for every single home buyer, because that is our goal, to make sure that everyone who wants to own a piece of property, his dream or her dream, can do that. So I don't know if we covered everything, gentlemen, or if I missed something. We'll just take a moment and sort of review that.
Yeah, I think anything you want to add, Brett?
Yeah, the only thing I would add is one of the other hot segments in the market in 2022, it's expected that 20% of the market is going to be investors, right? The investor market is still going to have a lot of velocity in 22. We do have some unique programs that are qualifying basically only on the cash flow of the property, not the income of the investor. As the market heats up on the investor side, and new phenomena, right? Airbnb is a new phenomenon. Not a lot of people fund those. We do have programs for Airbnb rentals. That is going to be a super hot segment of the market. So keep in mind, new home buyers are going to have a lot of velocity, as Jack had shared, and the investors are going to have a lot of velocity. And we want to make sure you're positioned for that in 22 and 23.
Absolutely. And I have learned a great deal, and I'm going to bother Brett because I have his email address and telephone number tomorrow. So I'm going to be right on the phone.
Perfect. Well, thanks, Pat.
Because there are lots of ideas. I think we have found the right partners who are going to help us open those doors for our folks, and make sure that we all really, really, really commit to that. That's really, really important. Cindy, I think we covered everything.
I have a couple of quick reminders, but I want to start off with congratulations to Pat. Everyone knows she was promoted to assistant general manager of Downing-Frye, and everyone is so happy for her.
And I promise that I'll do better in getting on Restream, gentlemen.
Hey, Pat, don't feel bad. It took me about 10 minutes too, because I'm a technology idiot, as Cindy well knows. So I'm thinking, wait a minute, I hate to have to call her and go, I can't get in.
Well, my Cindy's my undercover secret technology guru.
Too funny. I'm going to give a little shout out for anyone who's still hanging on. This week on Thursday, I think it's Thursday, January 13th, there is a virtual roadmap number 3 with the training department at Downing-Frye, because when you learn more, you earn more. The Words That Work was canceled because of a scheduling conflict on the 14th. And on January 17th, the Downing-Frye offices will be closed in observation of Martin Luther King Day. But Tuesday, the 18th, we'll be back with Virtual Roadmap 4, and that is about sales contracts. And then on Wednesday, the 18th, we have our monthly virtual sales meeting. There is always something going on at Downing-Frye, and so we look forward to seeing you at one or one of the future events.
Absolutely. Thank you, gentlemen. I appreciate your time, and we really do, and we appreciate all you do for your folks.
Thank you, Pat.
Thank you.
Thank you,
Cindy. Cindy, thank you.
Thank you for joining us for this episode of Ask Pat. You can learn more at downingfry.com and make sure to follow us on Facebook and LinkedIn.